Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Oil is on the way up. Cryptos are giving capitulation signals, and the markets are behaving like they did in 2000, the year of the dot-com crash. Author of The Money Bubble, John Rubino, wades in on whether the stock markets are topping, bonds, interest rates, precious metals, and battery metals, plus potential conflicts in Ukraine and Taiwan. Vancouver realtor Steve Soretzky tells us what's going on with the priciest real estate in Canada and what trends he says are ahead in the home buying and selling business. Outrageous bidding wars on single-family properties continue. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, an interesting couple of weeks to kick off the new year on the major stock markets. What's the story there?
Yeah, so the Santa Claus rally took us right up to the end of the year, and then somebody put a stop sign up there, and everything decided to halt, and we had a first pullback, and we went back and tried to test the highs, and it's turning into more of a trading range than anything else right now. But if you take a look at the internals, you know, what we're seeing once again is that there's real selectivity in terms of what's doing well and what's not. And this is sort of the deja vu of 2000 all over again, where the leadership from the growth stocks with potential earnings, everybody geared up for it. A year ago in the high-performing stocks, they've seen nothing really in the way of performance now for the last 10 months, just like the dot-coms of 1999 into 2000. And this transition to real value plays, which would be banks, they'd be things like the energy stocks, pipelines, they are just with good solid dividends. You know, when you can get a 4.5% on a Valero or a Exxon or Chevron, you can get maybe 6.5% on an Enbridge or a Pembina, Suncor, versus the dream of maybe getting something on one of those growth stocks. Everybody's moving now at this point to those more conservative plays, and this is exactly what we saw back in 2000. We did exceptionally well in 2000 through 2002, just for recognizing the transition that was going on. So that's what's happening now, and I think you want to make sure that you take advantage of it. So the plays at this point, I still think that energies have got quite a ways to go. We've got oil pushing up now through $84, right towards its $85 high of last year. The real resistance is up just over $100, and I can easily see that would come into play. That's another example of what happened back in 2000. The oil stocks just did famously as the market started to crack in the second half of 2000 into 2001. Oils are doing really well right now. And don't we look over to, say, the commodity side, where base metals having a nice run, precious metals, though, languishing in here. We've got gold and silver tried to get a decent start off the December bottom, but ran out of steam. even as the CRB is pushing its way back to the all-time highs again. So very, very much a market of stocks rather than a stock market.
What's going on with the Canadian dollar?
Canadian, we talked about this the last couple of weeks, has been really buoyant. It has been actually outperforming what we were seeing in the commodity side. It was only on Friday at the end of the week it actually gave back a little bit, but on the week up about 60 basis points. So trending well, and don't see any reason to see any negatives in there at this point. And that was a pretty good week with a weaker U.S. dollar. The dollar index had a bit of a consolidation for about 6 or 8 weeks, and then started to give up ground. And as of this week, got down to its 20-week moving average, which looked as though it should be a pretty good support level for a bounce. Wouldn't be surprised, though, that we see it maybe dip another 100 basis points on the U.S. dollar index before we get a better bottom in here right now.
What's going on with cryptos?
Cryptos, we got on some of the major ones, we got some capitulation signals in concurrent time frames. We look, when we're looking for some of these big turns, like the trifecta tops or the capitulation bottoms, we want to see the markets become overextended in more than one time frame. And what we got the early part of this week in Ethereum and also in the alt and the Bitcoin itself, we had some good capitulation signals on the 10th and 11th, and it looks as though we're getting a decent bounce out of there. The Bitcoin had a tough time when it rallied up and failed at the 52,000. And at this point, it looks as though it should probably get back maybe into the high 40s on this bounce. Good trading opportunity, but I always question the capability of that as a long-term hold. I just see it as a trading vehicle.
Ross, thank you so much for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. He's speaking to us from near Port Angeles, Washington State. Welcome back to This Week in Money.
Hey, Jim.
John, a lot of people think the stock markets are showing signs of topping. What are your thoughts on that?
Well, we're heading into historically what has been taper tantrum territory. The stock market is way up, the economy's been growing, labor is tight, interest rates are up, inflation is up, and the Fed is starting to talk seriously about raising interest rates. They just, I guess it was today, came out and said probably in March they're going to do the first interest rate increase with several more during the year. Now, normally that freaks out the financial markets because we're a credit-addicted society. So you start to take away the drug and the junkie starts acting erratically. And that's what's happening in the financial markets right now. It's gotten very volatile in the stock market, and today we're seeing a massive down day. Let me see. The NASDAQ is down 2.5%, which is a huge move for a stock index. As money rotates out of high risk, high growth tech stocks and into safer things. There's no reason to think that doesn't continue until the Fed capitulates and takes all the tapering stuff back. So what we have to go through, if history is any kind of a guide, is extremely volatile to the downside financial markets until the trend we're on of rising interest rates and tightening money is reversed out. So we'll see when that is. I suspect it's sometime this year and maybe sometime in the first quarter, because normally these things happen pretty quickly. You know, if the stock market drops by 10%, the Fed panics. And a 10% drop from the peak would be very easy to do for this stock market based on a, 2.5% drop just today in the NASDAQ. So, it could be really extreme going forward. The next couple of months could just be spectacularly scary for anybody who's long equities.
We keep hearing CPI numbers like a 7% increase in inflation, producers saying their costs are up 10%. What do you think the real rate of inflation is?
Well, we kind of know. We know the government understates. And that's a nice euphemism for lying, understating. But they do. They give you a favorable inflation number using a lot of statistical tricks. So you need to add 5 or 6 percentage points to whatever the government tells you. And that takes us up into the low double digits. 12, 13% is probably what U.S. inflation is for the average person who's experiencing it. And, it could be higher than that based on some really big numbers for used cars and gasoline and coffee and meat and many other things. You've got a lot of stuff going up by 15, 20, 30%. And, it's hard to see what is going down enough to offset those big jumps to get us down all the way to 6%. There really doesn't seem to be anything. So I would put the bottom of a reasonable inflation rate for the U.S. right now at 12%, and it could be higher.
Is this putting pressure on wages to be higher to cover it? I know we had the John Deere strike, and they pretty well got what they asked for, but are other people in a position to ask for more money and with their bosses hand it over?
Well, it's interesting what's happening right now because workers are getting pretty good wage increases, but it's all being eaten up by inflation so that we're still seeing negative wage growth in real terms. Even though, you might get a 5% raise, which is in most years recently pretty good. But if inflation was 6 or 7% official and 12% real, you fell behind big time this year. And that's what's happening to a lot of workers. That alone, though, does not generate big wage increases. What generates big wage increases is the fact that there's a shortage of good workers out there, and workers are figuring it out. They know they've got some power. So there's a shift in power dynamic in the market right now, away from capital and towards labor. And labor is using this, maybe brief, but certainly real, period in which they have a lot of power to claw back some of what was stolen from them in the past. So we're going to see strikes, mass walkouts, whatever it takes to get much higher wages, and companies are going to have no choice but to pay. So I think wage inflation is part of what's going to drive the overall inflation rate in the next few years, where, a lot of workers are going to get 10% raises, and that's going to push the overall inflation rate up several more percentage points than otherwise. So, it's an interesting time, and I think wage inflation is probably going to be a big part of the story.
Now, a lot of people are quitting or have quit because A, they got government aid, and B, they use some of that cash in the stock market, trading on Robinhood, and made money. What's their future look like?
Well, to the extent that people have made money trading stocks and feel like they don't have to work, they're going to have to go back to work if the stock market does a taper tantrum and tanks. Because and I know this because one of my sons is a big Robinhood trader, so I know the kind of stuff they trade. And it's usually penny stocks. It's usually very volatile things without a lot of fundamentals backing them up, but rising because there's, free cash flowing into them. That's the kind of stuff that just goes away in a serious market correction. So I think a lot of those guys, and the same thing with cryptos, a lot of people apparently feel rich enough they don't have to work because they made so much money in cryptos. Well, anybody who bought Bitcoin in the past year is down. So a lot of those same guys are going to be feeling a lot poorer going forward if current market trends continue. So as far as that goes, I think we'll see a lot of people coming back into the market because they thought they had money, but now they don't. But I doubt if it's enough to shift the balance back into capital's favor. I think there's going to be a shortage of quality workers for a long time, and that's going to result in rising wages. And then, that's a good thing for the guys who are on their couches trading on Robinhood right now, because it means they'll be re-entering the workforce at a pretty favorable time, so they'll probably do okay.
Gold seems to be moving higher, but it's still stuck in a trading range. What are your thoughts on gold?
Well, I think this is a spectacular long-term environment for precious metals with all the new currency that's being pumped out to cover all the new debt that's being taken on. Those are good times for precious metals because it leads to demand for safe haven assets. The very short term is also pretty good because it's seasonally gold's best time. January and February are usually excellent months for precious metals because Asian demand is very high during that time. And we're seeing that now. Gold is kind of trending. It's up above $1,800 US and still, even though with the down day today, it's still trending upwards lately. But you look a little further out and that stock market crash that is looming out there, if the Fed actually does start raising rates aggressively, would probably take gold and silver down too. So intermediate term risk is probably something we want to pay attention to in precious metals, just because the last 3 times we had big stock market crashes or flash crashes, gold and silver got swept down with everything else, and so they had V bottoms, bounced off of those V bottoms, but they fell dramatically, and so did the mining stocks. And that's a real risk out there right now. So I think it makes sense to keep some powder dry. If you have some cash on hand and we have another flash crash, then you'll be there to load up on gold and silver and the related mining stocks just as the Fed comes back and says, oh, did we say we were going to tighten? Never mind. We're going to cut interest rates. We'll give you negative interest rates. We'll give you massive QE. Don't worry. Just don't crash anymore. Start buying financial assets again. When the Fed does that, gold and silver will rocket. And if you're brave enough and smart enough to buy at the V bottom, you will make 3 or 4 or 5 times your money on those mining stocks and maybe 50% to 100% on your bullion. So pay attention. See if you can be one of those people this time around.
Is silver following gold?
Well, silver tends to, over periods of time, follow gold. They decouple a little bit when people get very worried, because at first, if you're very nervous about what's going on with, say, your tech stocks, you want to buy gold because it's the safest thing. And so silver goes down relative to gold, even though they might go up, both, but silver won't go up as much as gold. So the gold to silver ratio expands. And then when people get very cocky about safe haven assets, in other words, when gold has gone up quite a bit, then people start looking around for other safe haven assets, and they see that silver is wildly undervalued, and they pile in. And silver outperforms gold for a while. So, in that broad sense, silver does follow gold, it tracks gold. But it does it in an irregular way, when sometimes it underperforms, sometimes it outperforms, to get back to that average gold to silver ratio. So right now we're in the underperform part of it, but the outperform part is not that far away. Let gold and silver bottom during a stock market crash, and then let gold bounce off that bottom, and you'll see a lot of money flowing into silver as well, and silver will chase gold and eventually increase more in percentage terms than gold does.
I've always wondered why silver isn't much higher, because not only is it a precious metal, but it's also a widely used industrial metal. Have you been surprised with all this move to solar and more computer construction, because silver is such a good electrical conductor, that the prices haven't gone higher? And is there actually enough silver out there to meet that industrial demand?
Yeah, actually I am surprised, because you would think that silver would move up at least as much as most of the other industrial commodities, and it has underperformed them. So I don't have a good explanation for that, except to say that, sometimes things just don't behave the way they should, and then they make it back up later, and in the end, fundamentals wins. And with silver, the fundamentals are great, because like you said, it's an industrial commodity that is used in a lot of things that represent dramatic growth markets. Silver goes into electric cars. We're all going to be driving electric cars in 10 years. Silver goes into solar panels. Solar, despite some hiccups along the way, is going to be the main energy source of humanity 20 years from now. So, and of course, it's a monetary metal that goes up during periods of high inflation. So, I think silver's underperformance lately is basically just one of those buying opportunities that we'll look back on and go, oh my God, I didn't understand it at the time, but if I did, I would have mortgaged the house and bought silver eagles, enough to fill my spare bedroom. But so we'll see. But I do think that that's probably how it plays out.
Does it look like the bond market will force mortgage rates higher, and what could that mean for home sales and prices?
That's a huge deal for the economy, because the only reason anybody who isn't extremely rich can buy a house in the U.S. right now is because mortgage rates are really low. You make mortgage rates go up, and you take an already unaffordable housing stock and you put it out of reach for 90% of the population. So we would be depending on rich people paying with cash and foreigners coming in to buy U.S. real estate for our housing market, and those are not the most trustworthy pillars to base a market on. So I think it's very possible that, if inflation continues to increase, long-term interest rates go up because of inflation, that pulls up mortgage rates and that crashes the housing market. That could be a dynamic over the next couple of years. And you know what? It's about time. Houses are wildly over expensive. They should not cost as much as they do. And there are reasons why they've gotten this far, but I think all of those reasons can be reversed out by a 7% mortgage rate or something like that. And we could, easily see 4 or 5% mortgages. And with a little bit of, erratic to the upside interest rates, we could get up into the 6 or 7% range, and that would just blow up the housing market. So that's another thing that's out there that is pretty damn scary when you think about it.
Well, one of the driving forces for higher house prices was the price of lumber skyrocketed. And for people who thought, I'll use steel and concrete, well, rebar prices went crazy. And then there was a shortage of paint to finish off that house. So right there, you can see what drove maybe some of these higher prices, but that wouldn't explain the higher prices for resales.
Yeah, that's part of what's driving higher house prices. But you reach a point where nobody can afford houses, and then it has to stop. No matter what it costs to build a house, if nobody can afford to buy that house, then you're kind of stuck, right? And so this is a market that cannot continue on its current course because fewer and fewer people can afford to buy the end product. So rising building materials prices is a trend that is self-limiting. It pushes house prices up to a point where nobody can afford houses, and then it stops. So I think shorting lumber at this point would be a really good trade. Yeah,
and what happens when you hit super high mortgage rates? Back in 1981 in the town of Moose Jaw, a developer was losing money at a drastic rate because mortgage rates were at 21%. So he took a bulldozer to the 4 houses that he built. Unfortunately for him, his wife was in the 4th house, and the police had to point their guns at him to stop bulldozing the house that she was in. So, hopefully we don't get to that point. Now, Great Bear Resources was bought out at a nice premium. Are there more companies like that out there?
Yeah, everybody's asking that question now, because Great Bear is a Canadian gold explorer that found a lot of gold in the Red Lake District in Ontario, and just kept finding more and more gold, and its stock price went up commensurately. It was when I started looking at it in 2018, it was 39 cents a share, U.S., and it just agreed to be bought out at $23.90 a share equivalent. It was a Canadian dollar deal, but that's what it comes to in U.S. dollars. So that's like a 40 or 50 times increase. And it made a lot of money for a lot of people, and it's got a lot of people being very interested in finding the next one. So there's 5 or 6 other companies that are being tossed around as possible next Great Bears. And full disclosure, if I accidentally mention any of the names, I own all of them, so I'm talking my book from beginning to end when we get on to precious metals here. But, Novo Resources, El Oro, Newfound Gold, over on the East Coast of Canada, and several others are being talked up as the next Great Bear. And they all have interesting stories. None of them have done so far what Great Bear did, but they're putting up numbers that make it look like they could. Mm-hmm. And, you only need a couple of 50-baggers in an investment lifetime to be successful. So it's definitely worth looking for the next Great Bear. And, I think the environment's going to be really favorable for small miners going forward, right? If you've got the big miners using up all their resources, which they are, so they need to find new gold and silver somewhere, and they're not finding it on their own exploration programs, then they need to buy out the juniors in order to get the resources to keep themselves busy. And you've got rising gold prices at the same time, which makes, borderline economic properties suddenly profitable when you get a 20 or 30% increase in the thing that they're mining. That's just a really good environment for small miners. Now, here's an interesting kicker for the way the mining sector works is once people get broadly excited about junior miners, a lot of outside money comes in who really, they don't understand the market. So they basically buy anything with gold or silver in the name. It's like what happened in the dot-com market back in the 1990s. Anything with .com on the end of it went through the roof because people didn't know what they were buying. They were just buying that sector. And you'll see a lot of outside money come into the mining sector in this cycle towards the end, and they'll buy pretty much anything in sight. And historically, which is what makes this kind of a funny story, the crappy names, which are downmost because they're probably not successful companies, tend to go up the most because they can generate bigger percentage terms from their much lower bases than the successful companies can. So you could make the case that you should just get in early, buy every name with gold and silver in it, and then ride it up when all that outside ignorant money comes in. I'm kind of doing that almost accidentally just because I'm like a magpie. I just grab shiny objects, and that happens to be the gold and silver miners. So I own a lot of, probably kind of crappy names that are potential 10-baggers just because they've got gold and silver in their names.
Mm-hmm. Did you or do you own any of the properties we just talked about?
All of them.
Oh, good.
I said that before I started.
Yeah.
Full disclosure, I own all of those.
Do you think there will be enough battery metals to supply the growing electric vehicle market?
No, absolutely not. There is not enough copper in the world to satisfy the electrification that we're planning. And that's on maybe a little bit lesser scale. It's true for nickel, it's true for cobalt, it's true for several other things, including silver, by the way. So what has to happen is prices have to go much higher in order to pool currently uneconomic properties into production. Or we have to change our mind about electric cars and solar power and general electrification. So if we continue on the plans as they're currently laid out, we will bump up against supply constraints, which will lead to higher prices. No guarantee we do that. Maybe we'll change our mind and go back to fossil fuels, but right now that looks unlikely. So it looks like we're just going to use too much copper over the next 10 years, and that's going to make the value of high-quality copper mines go way up, which, copper is not a sexy metal compared to gold and silver, but I think a lot of these industrial metals and industrial commodities are going to behave like very sexy sectors going forward. They're going to produce some big winners, and they're going to make a lot of people very rich. And a lot of people who never really gave those things a thought are going to look back and kick themselves because they wish they'd paid more attention at a time like this.
The typical electric vehicle uses 83 kilograms or 183 pounds of copper. That's a lot of copper, isn't it?
That is a huge amount of copper. And then, remember, all the charging stations are electrical. And solar power requires a lot of copper and a lot of silver and other things. And it goes on and on. Pretty much every new power technology that you can think of uses a lot of these metals because electricity has to be transported somehow. And, we do that with copper. We do it with silver. There's no other way to do it. We don't know how to do it through the air yet without frying all the birds and the children and everybody who get in the way of those beams. So it's going to require copper and other things like that. So yeah. And see, the only thing that stops that from happening is a gigantic global depression or a war or something like that. Some kind of interruption in current trends. And those things are very possible. That's a legitimate risk. But, if those things don't happen, like if we continue to kind of plod along and, we grow a little bit even though it's messy and we continue with our current plans, we will run out of copper. You can bet on it.
NATO, Russia, China all seem close to armed conflict. Do you think there's a real risk here, or are they just saber rattling?
Huge risk because the U.S. is so stupid. We're blundering around the world, making a mess of everything we touch. And currently, the places where we're making messes are right in the backyards of nuclear powers who don't take kindly to what we're doing. So, Russia doesn't want us to bring the Ukraine, which is right next to Russia, into an anti-Russia military alliance. Surprise, surprise, and China believes that what's happening right next to China is China's business and not America's, which that's less of a clear argument, but it's still something that you can justify and that we feel the same way. Stuff that happens in Cuba, that matters to us. We're willing to fight for something like that. So, and to the extent that we're pushing Russia and China into positions where they have to defend what they clearly perceive to be their interests in their neighborhoods, we're risking something that we can't control. You start throwing these new weapons that are being developed out there at each other, nobody knows what's going to come of that. But I think there's a good chance that the U.S. does not come off well when we go all the way to the other side of the world and pick fights with people in their own backyards. That the logistics are not in our favor. And that would screw up the global financial system in a way that no garden variety financial crisis could do. If we wake up in the morning and overnight a shooting war between the U.S. and Russia has started, don't be long anything. Be short. You just better hope that the day before you went short every single conceivable financial asset because they're all going down.
Is COVID finally over?
Maybe I'm just a little bit too soon with this, but I do think that it's looking like it because it has evolved into a version that is really communicable. It's transmissible very easily. People get it a lot, but nobody dies from it. So if it's the flu now, you're not going to be able to justify all these draconian, borderline psychotic lockdown rules that we've got all over the place. I know you guys have some lately in Canada, Jim, that I've seen where they're raising taxes on people who are unvaccinated, and then of course Australia, where they just grab you off the streets and throw you into concentration camps if you don't meet the criteria of a favored type of citizen. So. I think that stuff's going to be a harder sell in a world where the enemy is the flu or a cold or something like that. And it seems like that's where we're headed. So thank God for that. This has gone on way too long, and the sooner it ends, the better for everybody.
I remember our conversation just before COVID was announced, and I said, what could upset the stock markets? And you said, a worldwide pandemic.
Yeah, that was a really funny conversation that we had right before this thing started, because you kind of asked me out of the blue about pandemics. And I went into kind of the standard, these crowded cities, all this experimentation, we could, blah, 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 and it turned out to be a really, for anybody who was listening, a useful conversation right before the thing happened,
Agenda 2030, the Great Reset, where you will own nothing and be happy. Do you think people are waking up to this being tied into the lockdowns, vaccine passports, and crazy mandates.
Yeah, it could be. I mean, that sounds a little conspiracy theory-ish, but I think there are times when there are conspiracies and the theories are true, and it could be that this one is just part of a bigger process of convincing people to accept arbitrary authority, which will then be used to lower populations, convert the energy economy maybe more quickly than would be comfortable for a lot of people, and change a lot of our other habits in order to achieve some stuff that the 1% believe is in the interest of humanity. They're not completely wrong about lower populations and factory farming and stuff like that. I don't disagree that we need to transition away from those things, but if we do it via a dictatorship, then there's going to be a lot of unintended consequences that might make the cure worse than the disease. So, market forces are going to take us in that direction. So we don't need a dictatorship imposing it on us, but it seems like that's part of their plan right now.
Do we have a lot of people with a lot of money and they don't know what to do with it because there's now virtual real estate? Somebody's created a virtual island with 300 properties, and they were selling them for $15,000 last year, and now they're into the hundreds of thousands, and they don't even exist. Is this just a case of crazy people with crazy money?
Well, it's what happens when you create, a 20% increase in the base money supply and just dump it into the market, because people end up with all this money. And, I don't know if you play poker, Jim, but say you win a big pot, then all of a sudden your mindset changes because you're playing with house money. So you're more likely to throw down a bunch of money on a bet that might not have been the best bet. But what the hell? You've got this extra money. Well, we have a whole world of people like that right now, and they're throwing down crazy amounts of money on things that make no sense. NFTs, come on, and virtual real estate, things that don't have a physical existence and don't have any use beyond something that happens in cyberspace. Those are the things that get sold when reality reimposes. In other words, when the money supply drops by 20 or 30% because so much bad debt is being wiped out and central banks of the world cannot keep up with the destruction of financial wealth, then these things just vaporize. These things that people were buying with that make-believe money, they vaporize because the make-believe money no longer exists to support the existence of NFTs and virtual real estate. So that'll all happen, and it always does happen. And my only question with stuff like that would be, how do I short them? I'm not sure how yet, but I'm looking for a way.
John, anything else we should be keeping a close eye on that we haven't talked about?
No, Jim, we covered the waterfront here.
I think we did. Bought a warehouse and set up a restaurant and brew pub. Thanks so much for being on This Week in Money.
Great. Thanks, Jim. Take care.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. Check out his website, dollarcollapse.com. Coming up, Steve Soretzky will be talking real estate. Our conversation with John Rubino took place on January 13th.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Steve Soretzky. He's a Vancouver-based realtor, online at stevesoretzky.com. Welcome back to This Week in Money.
Yeah, thanks for having me on. Looking forward to it.
Steve, your new Saretsky report, is it out yet?
Yeah, just kind of the year-end report there. I can get that on my website, stevesoretzky.com. Totally free. I don't know what this one was, 15 pages or so on the Vancouver housing market. So, yeah, certainly go check that out.
Are some homes in the Vancouver area selling for over asking and at crazy prices?
Yeah, I think that, the trend is alive and well, which is the suburban single-family houses are where all the action's at, or I would say the majority of the strength. That's kind of where we're seeing the euphoria. So, to start the year here, I mean, if you look again, covered in the report there that I put out, we ended the year with record low inventory. So starting 2022, we're starting with an all-time record low inventory base. And so just to start the year, you've got a problem where, you still have a lot of buyers out there actively looking, and there's no listings coming on, because it's that time of the year from a seasonal perspective, and we've also starting with a very low base. So what you have is basically, just a lot of intense bidding wars. And so we're seeing, I was involved in one, a couple days ago, 41 offers on a house, selling, $400,000 over the ask. And so we're seeing more and more of these stories. And I think, could you argue that we're getting close to a blow-off top? It certainly feels that way. The price growth that we've seen is unbelievable.
What's happening in the high-end luxury market?
I mean, I wouldn't really say it's that strong. It's much different than the 2016, housing market where we had a lot of foreign capital flows coming in, obviously from China. We're just not really seeing that same, I think last time around 2016, the housing market was almost like a top down. It was like the luxury market kind of like took off, and then like it filtered down into sort of like, your local market, and then into your entry level buyer market. Like it just trickled down. And like this time around, it's just been like at these entry level points. So everyone's looking for the entry level house, the entry level condo, the entry level townhouse. That's where all like the strength and activity has been. And then you kind of have like the high end of the market. Like, if you're looking for a house, let's say on the west side of Vancouver here, for $4 million, I mean, it's a balanced market. You can go in there, you can negotiate the price, you can go back and forth, put your subjects on there, take your time. But again, if you're looking for a $1.5 million house in the suburbs, I mean, you're going to have a lineup down the block and you're going to be competing with 15 people. So very, very different markets. And then this cycle is much different than the last 2015-16 cycle.
How did 2021 compare to 2020 for the Metro Vancouver housing market?
2021 was a all-time record high in home sales. So that surpassed the previous high that was set in 2015. Again, we just kind of touched on what, the 2015-16 cycle was all about. So the fact that we surpassed that in 2021 kind of goes to show you the amount of activity that's happening in the housing market. 2020 was also a very strong year. Outside of a couple months when the housing market was shut down, you probably would have had, very close to record high sales as well. So, it's back to back very, very strong years for the housing markets here.
Looking at charts for markets, and in this case, the real estate market, could 2016 and 2021 have formed a double top? I mean, I would say it's a double top. I don't know how you would sort of make that analogy in terms of, the definition of that. But I mean, if your question is, do I think that 2021 is arguably, the high in record home sales, I don't think you're going to be able to surpass that in 2022. I think we're probably getting closer and closer to, a near-term top in certain segments of the market. Anytime that the market goes up in a straight line for 2 years and you have back-to-back like strong home sales, you're always due for a pullback. I don't know if that's going to be this year or next, but something we're keeping an eye on. The July 2021 property tax assessments are now out for BC. What are the assessments showing for the different areas?
Yeah, I don't have them in front of me, but I think, a lot of people are aware. I think, again, single-family house in the suburbs, those assessments are up like 30%, 30+%. So, yeah, we're seeing higher assessment values, which I don't know we can get into in terms of the taxation ramifications of that. I think there's some confusion around that. So it's ultimately calculated by the city's mill rate. So the city basically sets their annual budget for the year. Basically, if your house goes up more than, everybody else, like greater than the average, then you're going to pay higher property taxes for that year. If your values just went up the same as everybody else's, the same as the average, you're probably not going to have really any increase in your property taxes because the cities will adjust their mill rate. So just because your house goes up 30%, it doesn't mean that you're paying 30% more taxes. But again, obviously, if your house went up 30%, and your condo, that maybe you own a condo and that only went up, 5%, then yes, the condo might actually, end up paying potentially even less taxes, just depending on where the mill rate's set.
So, in other words, if your property assessment doubled, you wouldn't be necessarily paying double the taxes?
No, definitely not. Like I said, it's basically the city will basically just set their budget for the year. Based on that budget, they'll have they'll have their valuations in front of them. They'll say, okay, well, based on, these property assessment values and based on what we need in our budget, this is where the mill rate, which changes every single year, should be set at. And so now it just comes down to that percentage of increase. So, again, if your house went up 30%, you might only pay an extra 5 to 10% that year in taxes, for example. So it's an important distinction to make, but, I think certainly in general, along with inflation, people are typically paying more for property taxes this year.
Are we likely to see more supply hitting the market this year?
I don't necessarily think that we've had people not listing their homes. I think that's a misconception. If you look at the condo market, for example, you've had record number of new listings for I think 7 or 8 of the last 12 months. So you've had a lot of listings, even parts of the detached housing market. I think last spring, I think we had not record listings, but we had healthy levels of listings. The problem is you just have so much buyer demand that's just absorbing those listings coming to market. And so, more recently we've seen a fall off in the listings, and that's sometimes hard to pinpoint why that might happen. I think anecdotally we're seeing some people saying, well, I kind of want to sell, kind of want to move, but, look how tight the housing market is out there. Am I going to find what I want? How long is it going to take me to find? Prices are moving so quick. It's kind of intimidating. I think I'm just going to stay put until this thing kind of boils over. So we see some of that. So yeah, I think the big thing, I don't necessarily to kind of filter through the noise. You really have to look at months of inventory. That's really all that matters. You could have record new listings, but if you got record sales absorbing those listings, it's an irrelevant stat. So all I look at is, okay, what's the months of inventory at? That's going to tell me the supply demand ratio, and that's going to tell me basically where prices are heading. And so right now, across the entire market, condos, townhouses, detached homes, we're at 1.8 months of inventory, which is it's too low. A balanced market's 4 to 5 months. So we're well away from a balanced market. Again, if you want to strip that out further and say, well, where's the hottest segment of the market? We've already talked about it. It's the entry-level detached house. So if you're looking for a house under $2 million in Metro Vancouver, you're sitting at 0.7 months of inventory. So, how do we, and that's not surprising that we've got 15 offers in every house. You have 0.7 months of inventory, and that's why we're seeing crazy run-ups in home prices in that segment. And so just to get to a level where the prices can start to kind of cool off, where you can start to arrest price appreciation, you need to get to at least probably 3. And so that's not going to happen in a week or 2 weeks or 2 months. That's going to take several, minimum, probably 4 to 5 months just of slowing demand and slowly rising new listings to get that months of inventory to a more healthy level. So that's kind of where we're at right now. It is kind of a dire picture. I would call it a crisis. And government doesn't seem to be doing a whole lot. So, here we are.
Are the banks fueling real estate with easy money? Yeah,
residential mortgage lending growth is running at its highest level since 2008. And that's really, I think, what's been driving it, right? We talked about it before, like, why is the high-end luxury market not really moving like it was in the last cycle? Because it's different dynamics this time. It's predominantly, the borders are basically shut down. I mean, if you look at the buyer that maybe would be coming from overseas in China, I mean, they've got COVID zero lockdowns over there. Nobody's leaving the country. So, there's not a whole lot of money from there that's really coming into the market at this time, which is probably hard for some people to believe because everybody says, well, where's the money coming from? The money's coming from the banks. What we see is residential loan growth at 12-year highs. Everybody's getting, I call it like the wealth illusion, right? Everybody's making money hand over fist in the asset markets. Stock market's at all-time highs. Real estate's at all-time highs. So, you typically see is parents tapping into that home equity loan because their house just went up $1 million over the last 18 months. Giving $250,000 to their kids, and that they're using that to push up the prices of, some of these single family homes or townhouses or what have you. So, I mean, that's really where the money's coming from. If you look at the bank's perspective, whether you like it or not, they were tapped on the shoulder at the onset of the pandemic to get money out the door. The regulators wanted the banks to lend money to avoid a, deep recession, depression, whatever you want to call it. And that money, if you look at it from the bank's perspective, I mean, are you going to issue new loans and new credit to, businesses that are on the verge of failing? No. Are you going to lend it to the retail space? Seems kind of risky. Are you going to lend it to the office space? I mean, everybody knows the decimation that we've seen in the office space. Yeah, that's not very attractive to the banks either. Where are they going to put it? Oh, the residential housing market, that's pretty safe. It basically has a government guaranteed backstop. And so that's kind of where the loan growth has been happening. And now you've more recently seen, the big bank CEOs coming out and saying, hey, Bank of Canada, you guys need to hike interest rates because, we need to get this housing market under control. Why? Because, as a big bank CEO, you don't want to lose market share to your competitors. So you can't just like, oh, hey, the market looks a little bit frothy. We're going to start pulling back our lending and really reining it in and losing all of our future clientele to these other banks or lenders. So, basically what you have is a situation where the banks now are pleading with the regulators to put the brakes on the housing market. And so that will be something that we're watching pretty closely here for 2022.
Could interest rates become the elephant in the room?
I mean, I have a fairly strong view on this. Again, I'm happy to be wrong, but I think I've been on the show many times before. I think that we'll have some rate increases this year. I think the Bank of Canada probably gets 2-3 rate hikes in this year. But I think ultimately there's just way too much debt in the system. This economy is so over-leveraged. And it's not just the Canadian economy, right? I mean, global debt to GDP is at 365%. The whole entire world is levered. And if you remember, in 2018, when the U.S. Federal Reserve started hiking interest rates, December 2018, they blew up the stock market and they instantly started cutting interest rates. And that was at a time when, you think about how much more debt we've added since 2018, particularly since the onset of the pandemic. So, you could argue that the central bank's quote unquote neutral rate, which is where they see sort of longer term, their overnight interest rate policy being, that continues to fall lower and lower because when you have this amount of debt, interest rate tightening cycle is much shorter. So long story short, to kind of simplify that for the listener, is I think that we're going to get stopped out well before where we did last time. So the Bank of Canada, I believe, hit 1.75% on the overnight rate before having to reverse course and ultimately cutting rates back down to zero. So, where do we get this time around? We're obviously at 0.25 right now. Do we get to 1%? I think that's very realistic. I think as you start to climb north of that, I think that something will probably trigger a blow up in financial markets that will force central banks to reverse course. So that's just my personal opinion. I know there's others out there that share that view, and I just don't think that the system is capable of going back to quote unquote normalizing interest rates. And just because inflation runs at 5%, it doesn't mean that interest rates are going to reflect the level of inflation. In fact, if I was a central banker and I had a debt problem, I think inflation is wonderful. These guys make no mistake. I mean, they might tell you publicly in the media that inflation's a concern, but I think these guys are probably pretty happy because, again, if you've got a huge debt burden, inflation certainly helps ease that debt burden. So central banks have been bemoaning for the last 10 plus years that inflation has been below 2% and they're struggling to generate inflation, and now they've finally succeeded in doing so. So I think they'll continue to let it run hot. I think real interest rates will continue to remain negative on a real basis for a very long time.
Are people taking on more and more debt to buy investment properties?
Yeah, I think we're seeing some of that, refinancing for sure. I think this is creating, I think it's very evident, these policies that are put out there, they are creating larger wealth inequalities. Central bank keeping rates at zero and QE and federal government, basically doing helicopter money, like, great, feels good, right? But I mean, at the end of the day, it is creating larger wealth inequalities because, if you think about a typical scenario, I can give you an example. I got a client that bought a house for 1.2 last year. I mean, today, 12 months later, it's worth 1.6. So, I mean, if he's a smart guy, which this guy is, he could tap that home equity, hypothetically, you can take the $400,000 right out, quote unquote equity, thin air, that was made out of thin air. You could take that $400,000 out and go buy, 2 investment properties with that. There's your down payment for the next 2 properties. So, what you have is a situation where, if you're an asset holder, you're arguably getting wealthier and doing better. And if you're not, if you're just a 9-to-5 laborer, on an income, you're getting decimated right now. And so, it's fascinating and concerning from a policy perspective, because I think the policymakers are kind of asleep at the wheel.
As far as real estate bubbles go, where is Canada currently ranked in the world?
I don't know. I mean, I heard some sort of stat or something the other day. It was like number 2. But again, I don't know. I don't really put a whole lot of stock on that. I mean, how do we measure these bubbles? Vancouver and Toronto have been on these charts for the last 12 years. And don't get me wrong, I'm not going to sit here and say that valuations are sustainable in Vancouver or Toronto and that they're going to go up and you better buy now. I don't share that view. I think that we're just in an era today where the currency is being debased at an unprecedented pace. Inflation currently running at 20-year highs. Again, in my opinion, still underreported at whatever it is in Canada, 5.5%. It's certainly much higher than that in real life, for most people. And so, I think that what you're seeing today is real estate, which is a hard asset. Land is a hard, tangible asset. That you have a situation where you've got, a fixed amount of debt applied against a hard asset. So let's call it, $1 million mortgage against a hard asset. And, every single year the currency is being debased by whatever you want to call it, 5, 10, 15% a year. The debt burden on that hard asset is getting, cheaper essentially in real terms, every single year. And so that's why real estate is gone up. I mean, some of these houses have doubled since the pandemic. National home prices, not just in Vancouver or Toronto, national home prices are up something like 34% since the start of the pandemic. I can tell you wage growth is, maybe up 3 or 4%. So, that's just what it is. And so policymakers continue to kind of beat around the bush, which is, let's put in another little tax here and let's build 74 affordable homes here. And let's talk about bringing in a, 1% tax maybe on foreign buyers. And this is all you're doing is just kind of dabbling around the fringes. At the end of the day, you've got real negative interest rates, running at negative 2, 3, 4, 5, 6%, for the next 5 to 10 years. I mean, it's not going to matter what you do.
Is real estate being used by some as a safe haven investment?
For sure. It's a safe haven investment. I mean, again, it's very, very simple. I mean, I think the global bond market is I don't even know how many trillions of dollars. I think it's the single largest asset class. Let's put it out there. The bond market is the single largest asset class. I would say for most people, it's essentially uninvestable at this point. Again, like if you look at, what's happening in the bond market, you got U.S. inflation, for example, at 7%, and what's the U.S. Treasury? What's the 10-year on that? It's 1.7. So in real terms, it's like your real return of negative 5%. It's an uninvestable asset class, and so same thing. It's like leaving your cash in your checking account because maybe you don't want to buy bonds, so you leave it in your checking account. Well, again, if inflation in Canada is running at, let's call it 5%, I would argue it's in the double digits because CPI is a horribly massaged index. That's a tax that you're paying every single year on your money. You're paying 5-10% a year. Your cash is sitting in your checking account earning zero. It's being slowly eroded away. So what are people doing? They're going, well, I gotta do something with it. And so why don't I go buy a 1-bedroom condo, or go buy a pre-sale condo? And that's just what they're doing. Again, you can like it or not like it. That's just what people are doing. I think they're making, I would argue that they're making a rational decision, which is the government or the banks are offering them, fixed term debt at 2% with inflation at 5%, and their checking accounts earning and savings accounts earning 0. They're making a rational decision, which is, I got to put it somewhere. I got to put it to work, and that's what the policies and policymakers are encouraging people to do. So, I think that it is a safe haven asset.
Is the U.S. dollar still the safe haven currency?
I mean, I don't have any strong views on that in terms of, I'm not going to pretend to be an expert on foreign exchange, but obviously it's the world's reserve currency. I don't think it's going anywhere anytime soon. I mean, personally, if I'm, a Canadian, I definitely want to have exposure to currencies outside of, the Canadian dollar, particularly looking at our, the amount of debt that we have and really what's happening in politics here in Canada. I mean, I would certainly want some exposure to the world's reserve currency, the U.S. dollar.
It looks like China's having a significant economic downturn. Are you seeing this as being a cause for any foreign buyers to sell their real estate holdings around Vancouver to cover their losses in China?
No, not seeing that at all. I mean, again, we'll continue to watch it, but yeah, not seeing that at all. If we look at China, yeah, they've, nobody knows over there. Everyone in the West is just kind of guessing and, reposting articles. And, we've been calling for China's imminent doom for the last, 10 plus years. They've got some wobbles in the property market, for what we can see. Everything that I'm looking at, it seems that the Chinese central bank is now easing. Credit stimulus is turning up, so they're basically easing as the rest of the world, the Fed starts to tighten policy. So again, I don't have any strong views of that. I mean, it's always going to be a risk factor. I think everybody knows that the Chinese property bubble has been the most fun thing to talk about outside of maybe Vancouver and Toronto housing prices. And so, yeah, it's always going to be a risk that's out there, but there's nothing that's happening at this moment, that suggests, detonation here and a flood of people listing their homes to cover bad losses over there. We're not seeing that.
If a buyer backs out of a signed pre-sale condo deal, would they just lose their deposit, or could they be on the hook for more?
Typically you get sued. You get sued for any damages. Damages being, if the developer decides to have to resell that unit for, $50,000 less, they'll take your deposit and then sue you for the $50,000. I think we saw some cases of it in 2008 when we had the last real correction, arguably. But yeah, sir, it's definitely not on anyone's radar right now. I think the pre-sale market is actually just ramping up right now. It's something I would watch for. Over the next 12 months, I think the pre-sale market is going to be a disco inferno. It's going to be red hot. It follows a similar trend as it typically does, right? So the rest of the market goes up, the higher end of the market goes up. That money, people start to get priced out. They go down the housing ladder. that as that heats up the condo market, and as people see prices rising across the broader market, they start to go out on the risk curve, which is essentially they look for pre-sale condos that are completing, 2, 3, 4 years out, because the assumption again is that, well, the prices are rising now, they'll probably continue to rise, and so by 2024, 2025, this will be a great buy. And so, I think that the pre-sale market, again, I'm not a huge proponent of putting clients in there per se, but if I had any sort of conviction on it, I think it's going to be an extremely hot market this year for pre-sale condos.
Lumber prices again this year are rising like they did last year. Is that a concern for people trying to build affordable housing?
Well, yeah, it just goes into the whole. It just goes into the whole, I just look at who suffers the most. I mean, I think it's the lower middle class that is already being squeezed by housing affordability, cost of living, and now, these costs basically get ultimately, for the most part, a lot of these costs, maybe not the whole thing, but a lot of these costs get passed through to the end user, right? So it just results in, more expensive housing. I mean, I was talking to a large developer, a couple of days ago, and, they've got construction costs since their last project. I think it was in 2019 that they finished that one up. They've got the construction costs up between 30 to 40%. And that's a combination of labor cost, or lumber costs, windows, piping, so your PEX piping for your building, copper wiring for your electrical, the cost of concrete, everything is up. Not only that, but the cost of labor is obviously up. And so they're basically like, listen, either we're gonna make a decision here, and if we feel like we can pass these costs through to the end consumer, then we'll push forward, and if we can't, we'll sit on it and we'll just wait. And so, again, as a developer, they're running a business. They have a P&L. And so this is not a charity. And so they'll have to make decisions of, do we feel we can still make a profit here and at least absorb maybe part of the cost and pass some of the costs on? Or do we just, shut it down? So, and that will certainly potentially impact housing supply moving forward. I mean, I think that most of us can agree we could probably do for a little bit more supply here, but this could be a problem moving forward.
Is slow building permit approval and project approval still driving up prices as well?
I mean, it's something, in my opinion, that's never going to get resolved. Bigger and bigger governments just becomes more inefficiencies, and so it's just. Okay, so in the city of Vancouver, for example, it takes 12 months roughly to get a permit approved to build a new single-family house. I mean, that's just holding costs, right? So particularly on a parcel of land, which now costs you minimum $2 million. I mean, to have $2 million tied up and doing nothing for 12 months while you wait for a permit and you pay, mortgage costs, property taxes, utility bills. Those are just added costs. And so the same thing could go for a condo development. If it takes basically on average, let's call it 3 years to get a property, rezoned and approved for, apartment building, those are just costs that basically just get passed on through to the end user, whether that's through higher rents or through resale prices. Because again, developers are running a business; it's a profit and loss business, and so if there's no profit to be made, they don't build. And so even if the city is successful, and we're successful in lowering the amount of red tape, so a permit goes from 12 months for a house down to 10 months in a best case scenario. In my opinion, that it's not really going to move the needle. So that's kind of my thoughts.
Steve, how can people get in touch with you and get the latest issue of the Saretsky report?
Best is just email me, Steve at stevesoretzky.com. And, the report's up on my website, both websites, but best to check out stevesoretzky.com.
Steve, thank you so much for being on This Week in Money.
Thanks for having me on, Jim. Appreciate it.
My guest has been Steve Soretzky. He's a Vancouver-based realtor. You can find him online at stevesoretzky.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Steve Soretzky. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now, stand by for a company showcase update from American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with American Manganese CTO and Director Zarko Meseldzija. Zarko, Happy New Year and welcome back to Company Showcase.
Thank you, Jim. I'd like to wish everyone Happy New Year as well.
With the new year, this is our first broadcast on Company Showcase for the year. What kind of direction is the company planning to go in 2022?
Well, first of all, I'd say I'm pleased to be back on the podcast to kick off the new year. Larry has asked me to step in this week as he's resting at home, recovering from pneumonia. He is doing well, and we do talk daily, and I can hear that he sounds much better. But I think this is a well-needed rest for him because I don't think I've seen him take more than a few days off since I've known him. He is strong and dedicated to his company and its shareholders, but nevertheless, he thought it would be best if I give an update this week on the RecycLiCo demonstration plant and Wenden Stockpile. Now, this week, I'd like to first start off with a few comments on the Wenden Stockpile because I know many listeners are looking for an update. So with our initial lab-scale project, awarded by the U.S. Defense Logistics Agency, or DLA for short, it gave us key insights to the Wenden material and confirmed the viability of the company's patented manganese recovery process, which we had reported to the DLA. But what I can say now is with the successful completion of the project, we are in ongoing discussions with the DLA about a potential follow-on project. I can't say more than that now, but with the need for EMM, or electrolytic manganese metal, and advanced forms of manganese more broadly, we're confident that AMY has a positive role to play. Now, switching gears to the demonstration plant work, we have received a large shipment of equipment and cathode scrap feedstock material. To be honest with you, we do feel very fortunate to have received the equipment, given the horror stories I've heard from other companies about supply chain shortages and even some of our own local weather delays here in Vancouver. Therefore, we are aware that we need to stay proactive and look ahead to ensure smooth transitions in our development work. Now, focusing on the project, we are currently working on assembling equipment and still targeting for February. Now, following assembly, we need to do water testing of all components prior to feeding material through the plant. This is standard practice and good practice to find any unknown unknowns and ensure everything is in good working condition to prevent hiccups and de-risk operation. For the demonstration plant operation, this will consist of continuous and long operating days along with periods of analysis to confirm operating conditions and look for any optimization points to increase efficiencies and throughput. All in, the testing will provide us more detailed data for scale-up and commercial cost structure as intended. But also with the plant's 500 kilogram per day processing capacity, we will be producing lots of material relative to our prior pilot plant. And this is material that we can package in bulk samples for the interested third parties to validate and secure business relationships to align with our licensing and joint venture business model that I talked about during the last podcast. Now, it's already turning out to be an exciting year, and we can't wait to start testing on the hydrometallurgical recycling plant of this size. As I mentioned during the last podcast, do not confuse this hydrometallurgical processing capacity with the mechanical shredding capacity for recycling whole EV battery packs, which are much heavier. Now, and as a final comment on the industry in general. Seeing the gap between the raw material supply and demand for lithium-ion battery materials, makes it a really exciting time to be involved in projects along the supply chain, and there's so many opportunities. For instance, I've taken part in a discussion session with groups such as BMAC, which is the Battery Metals Association of Canada. And part of this group are representatives from Canadian companies and streams such as mining, chemical processing, battery components, and battery recycling. And these, companies and representatives, we all want to grow the battery industry in Canada and expand the domestic supply chain. It's amazing connecting with experts in these fields to try and piece together a complete battery supply chain plan that can provide actionable insight for the Canadian government and for Canada to become a major global player in this new energy transition. After all, we do have the resources and talent here in Canada.
Zarko, for people who are new to the company, what is American Manganese all about?
American Manganese is a critical metals company focusing on the recycling of lithium-ion battery waste material for metals such as lithium, nickel, manganese, and cobalt.
And where are you traded?
We're traded on the Toronto Venture Exchange under the ticker symbol AMY, on the OTCQB under AMYZF, and on the Frankfurt Stock Exchange under 2AM.
If people want some information on the company, where should they go?
So everything's on our website. We at www.americanmanganeseinc.com. There you can find our phone numbers and email addresses for myself and Larry and others. So don't hesitate to reach out and ask any questions if something wasn't clear.
Zarko, thank you so much for being on Company Showcase, and all the best in the new year.
Thanks, Jim.
My guest has been Zarko Meseldzija, CTO and Director of American Manganese. I'm Jim Goddard. Our conversation took place on January 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.